Hi everyone. Finance Minister Nirmala Sitharaman in the budget for financial year 23 announced the setup of digital banking units in 75 districts in India with the main objective to reach the financially untouched areas of India. On the other hand, Niti Aayog, the think tank of India, lately submitted a report to the government citing the significance for the establishment of digital banks in the country. And to make things more complex, there already are the traditional banks, small finance banks, neobanks, and non-banking finance companies which are already prevalent in India's financial space. So when we already have so many existing financial entities, then why is Niti Aayog pushing for these so-called digital banks? And that too even after Finance Minister's announcement for the digital banking unit. Well, that's what we will decode today and try to unwrap. First of all, why is there a need for so many financial entities to serve the same industry in the first place? Secondly, what are these neobanks, digital banks and digital banking units and how do they differ from each other? Thirdly, why digital banks are the future for our financial system and how they will elevate the economic scenario of our country in times to come. So, in order to unpack the first dilemma, let's address this with two demand segments for credit in India: the MSME demand and the retail demand. MSMEs in India constitute 30% of the total national GDP and are responsible for generating more than 100 million jobs. According to International Finance Corporation, the demand for the MSME sector stands at 37 trillion rupees, of which banks and the other financial institutions are only able to fulfill 10.9 trillion, thus creating a gap of 26 trillion, which is, by the way, growing at an immense annual rate of 37%. As for the retail segment, India has 220 million credit eligible customers, of which the banking domain is servicing meager 33%. This balanced 150 million customers will have credit needs to be served in the future as the economy grows. Another statistic which proves supply shortage is from the Bureau of Indian Standards, which states that a healthy household debt to GDP ratio for an economy to grow is 55%, whereas India is still at only 12% ratio, which clearly depicts a growth slump. So, in order to cater to and fill these gaps in India's credit demand and supply, India is in need of more digital-based platforms, which are backed by favorable government regulations along with the cutting-edge technological offerings to deliver instant fulfillment. These digital banks will not be bogged down with the limitations which have been dragging back the neobanks and will be able to introduce new innovative products and services to the customers. Now, since we understand the need for the establishment of more of these financial entities, let's discuss each of these in detail. So in order to identify the role of digital banks, first let's understand the model of neobanks and why are these not the ones which can serve as digital banks for the Indian finance industry. So what is a neobank and what is its model? To understand, let's take a prospective neobank entity by the name ABC. Now for ABC to establish itself as a neobank, it will have to partner up with the traditional banks like ICICI, HDFC, etc. And for representation purposes, let's take Big Bank 1 and Big Bank 2. Now the reason behind the partnership is 1. Neobanks are not allowed to introduce fresh products on their own in the market. So in a way, traditional banks act as regulators for neobanks. 2. These banks will act as a utility product providing layer and ABC will provide the engagement and the customer acquisition layer. Now for revenue, ABC will provide either customer-facing product offerings or business-facing product offerings, or both, which are mainly technology-driven. Customer-facing offerings could include digital debit cards, personal finance management tools, investment options through its app via partner bank or a credit line. Business-facing offerings could include expense management products like employee prepaid cards, payroll management, accounts receivables management platform, and business loan or credit line via the partner bank. Now, for ABC to generate revenue, let's consider a customer, Mr. Verma, who wants a loan but does not have the time to reach out to a bank. So, Mr. Verma will be approached by ABC, who will offer him a free current account and other product services whose costs are on ABC's books, but the loan is dispersed by Big Bank 1. So ABC gets a commission fee from Big Bank 1 on the disbursement of Mr. Verma's loan. Also, ABC was able to make interchange fee on the debit card offered to Mr. Verma on the current account. And ABC is able to charge for software tools offered to Mr. Verma. But that's where the revenue streams end for ABC and neobanks in general. We know how the neobanks work. But why can't these serve as the digital banks when they have the technological stack and environment already in place? Well, neobanks suffer from a lot of limitations. Number 1, limited revenue potential with interchange, which is indirectly regulated in India, and a fraction of interchange available on payments processed through cards. Currently, the MDR for credit cards is at 2 to 3% of the transaction amount, while no MDR is levied on the usage of RuPay debit cards on the UPI. Visa and MasterCard debit cards, however, levy 0.4 to 0.9% MDR. Number 2, neobanks kind of work under the umbrella of traditional banks. They are not allowed to introduce their own products in the market. Instead, they can offer tailor-made services on the top of the products being offered by traditional banks. Number 3, easy entry to neobanking space for anyone because of low entry barrier. This will allow even unfit players to enter the market and dilute the market. Also, this will promote players to copy existing models for similar services, which will hamper innovations from taking place. Number 4, low scope of profitability since the customer acquisition cost involved is quite high and it cannot be offset by higher or scaling revenues since it's not in the nature of the neobanking model. Alright, so coming on to the digital banks and digital banking units. In order to understand the relevance of the digital banks and their working models, let's first put the difference between DBUs and digital banks to rest. DBUs are just a closed-by branch near your home which will mainly help the financially isolated regions with the benefits of digital payments, banking and fintech innovations. In legal terms, these DBU will not have a separate legal entity or a balance sheet of their own and thus are not licensed under the Banking Regulation Act. They will help in providing exposure to the people of the geographies where they are set up in order to educate them and help them make more digital footprints. Digital banks, on the other hand, will be actual legal entities which will be registered under the Banking Regulation Act. These will have their own operations, run on their own balance sheet, and will be far more cost efficient than traditional banks. And their technological architecture will help support other small banks and financial institutions. Let's look at this in terms of financials. Also guys, we will be simplifying the calculations for ease of understanding. Let's say interest earned on products is 100 rupees. Income from other sources is 10 rupees. Total income from all sources comes out to be 110 rupees. Interest expended to savings account and other liability products is, let's say, 40 rupees. Also, operating expenses stand at rupees 25, which may include staff cost, property cost, depreciation expenses, and other operating expenses. Now, net interest income, which is interest earned minus interest expended, comes out to be 60 rupees. Now, operating income, which is summation of net interest and income from other sources, is 70 rupees. And finally, cost to income ratio, which is operating expenses divided by operating income, is 35.7%. Now, total cost to earning profile of a digital bank would look exactly the same, barring the operating expenses, which would go down drastically since the digital bank does not incur property cost and also employs far less employee staff in its operations as compared to a traditional bank. This 7% figure makes a digital bank far more cost efficient than a traditional bank, whose ratio stands at 35%, therefore proving the hypothesis that the digital bank model will be highly effective in terms of its cost structure. Now, to support the argument of how a digital bank would help support other small banks and financial institutions, let's understand this with an illustration. Suppose a small cooperative bank, say SB1, wants to scale its customer base to increase its revenues. It can either upgrade its existing technological architecture, which by the way will be far too costly for such a small bank, or it can partner with the digital bank DB1, which will be able to provide its own cloud platform, proprietary software solutions, and expert risk staff for an interest fee income. This partnership will provide SB1 the scaling it's looking for, and DB1 a higher net interest margin in its books, thus creating a win-win situation for both parties. Therefore, digital banks are sure to serve the highly unserved financial base of the country, both directly and indirectly, thus elevating our banking industry to newer heights of growth. This is the disruption which should already have come to the Indian banking system long ago. But then, as the saying goes, it's better late than never, right? So that's all for the episode today, folks. If you liked the video, please hit the like button below and subscribe to the channel for more such knowledge-filled content. I'll see you all in the next episode. Mindfulness signing off.